ancient Mesopotamian city, cuneiform tablets, a market scene with people trading grain and silver. To understand the paradoxes of our modern economy, we need to travel back more than 4,000 years, to Mesopotamia, the cradle of civilization. Here, the earliest form of written money appeared. Not coins, not paper, but clay tablets inscribed with debts and credits. Farmers, merchants, and kings relied on these records to track who owed what. Sounds simple, right? But even then, human behavior, greed, ambition, fear, began to distort the system. Visual, close-up of a cuneiform tablet. The Sumerians and Babylonians introduced the concept of interest. Borrowed grain or silver came with an obligation. Pay it back, plus a little more. And just like today, those who controlled the flow of credit had the power. Visual. Timeline overlay from 2000 BCE to present. Fast forward to ancient Greece and Rome. Citizens, merchants, and even emperors were engaged in sophisticated financial activities, loans, bonds, public debt, and banking houses. Crises were not rare. They were inevitable. Rome faced hyperinflation, public defaults, and social unrest triggered by economic inequality. Sound familiar? What's fascinating is that these early financial systems already contained the seeds of the paradoxes that haunt us today: wealth concentration, debt dependency, and speculative bubbles. And much like today, the fixes often made things worse. Visual, animated map of ancient trade routes connecting Mesopotamia, Egypt, and the Indus Valley. Trade is the lifeblood of economies. Early civilizations discovered that wealth could expand faster than the goods themselves. Money became a symbol, not just a tool. Merchants in Babylon and Alexandria started leveraging credit to finance ventures, creating early forms of speculation. And as with every speculative system, bubbles formed. The crucial turning point came when governments began intervening. Kings issued edicts forgiving debts during crises, a primitive form of stimulus. But these resets were temporary and often led to greater inequality. Those who had access to credit before the reset became richer relative to the debtors. Sound familiar? Fast forward 4,000 years, and modern central banks are performing the same ritual. The blueprint was clear: centralized power, debt cycles, speculative booms. As societies evolved, so did financial complexity. Medieval Europe saw the rise of trade guilds, early banking families, and mercantile republics like Venice. Gold and silver became universal currencies. Credit became a tool not just for merchants, but for governments to fund wars and infrastructure. With these innovations came a rise in speculative bubbles. In 1637, the Dutch tulip mania demonstrated that asset prices could detach from reality entirely. And yet, the elites who controlled credit and capital often survived unscathed, while ordinary investors bore the losses. This echoes modern crises, from the 2008 housing collapse to the cryptocurrency crashes of today. What we see is the replication of the ancient blueprint: credit expansion, speculation, debt accumulation, bubble burst, and selective protection of the elite. Human behavior, it seems, hasn't evolved nearly as fast as financial instruments. History is littered with breaking points, moments when the system could no longer sustain itself. Ancient Rome faced rampant inflation as emperors minted coins to pay soldiers, eroding trust in money itself. In medieval Europe, banking collapses caused localized famines and social unrest. Each collapse followed the same rhythm: overextension, speculation, unsustainable debt, and the inevitable reset. Modern parallels are uncanny. The 1929 Great Depression, the 2008 financial crisis, even the stagflation of the 1970s. Each crisis followed the ancient pattern: debt accumulation. Every financial collapse leaves a trail of inequality. And the more centralized the financial system, the more concentrated the recovery benefits. The powerful get richer, the indebted remain trapped. Ancient Mesopotamian merchants became city-states ruling elites. In Rome, wealthy patricians survived economic turmoil while plebeians struggled. Today, we see billionaires growing wealth exponentially even during recessions. It's a paradox. Economies grow, yet most people feel left behind. Crises are not anomalies. They are features, embedded in the system itself. Over millennia, societies have attempted to fix the system. Debt forgiveness, interest rate adjustments, central banking, stimulus packages. Yet the results are often temporary. Why? Because they address symptoms, not the underlying blueprint. Speculation, debt dependency, and power asymmetry remain. The lessons of history are ignored, and the cycle repeats. And yet we act surprised each time a bubble bursts. Each new era is sold as unprecedented, even though history proves otherwise. Today, the blueprint is alive and well. Wealth concentration is extreme. The top 1% control more than half the world's assets. Speculative markets, from tech IPOs to cryptocurrencies, echo ancient bubbles. Central banks intervene, bailouts protect the elite, and citizens shoulder the risk. Visual, side-by-side comparison of Babylonian and modern debt levels. And it's not just numbers. Social unrest, political polarization, and mistrust in institutions are rising, just as they did during Rome's collapse or the French Revolution. History doesn't just rhyme, it repeats with alarming precision. Let's look at the numbers. Global student debt is over $2 trillion. Housing prices in major cities have skyrocketed while wages stagnate. The wealthiest 1% saw a 30% increase in net worth during the COVID-19 pandemic, while global poverty surged. These are not isolated incidents. They are the latest manifestation of the ancient blueprint, rewritten for a digital age. So, what can we learn from 4,000 years of economic history? Financial cycles are inevitable. Booms, busts, debt crises, and bailouts are not anomalies. They are system features. Concentration of power is a constant. Elites who control credit and capital always benefit disproportionately during crises. Human behavior hasn't changed. Greed, fear, speculation, and overextension are timeless drivers of financial paradoxes. History warns us, but it does not guarantee change. The blueprint is clear, and the pattern is unmistakable. Will we recognize it before the next crisis hits, or will we continue to repeat the mistakes of civilizations long gone? The answers may determine not just the health of our economies, but the future of our society. Eye-opening, dive deeper. Like, subscribe, and hit the notification bell to join our journey uncovering the hidden forces shaping our world. Comment below. What do you think is the next chapter in this ancient blueprint? Let's explore it together.